Well, good afternoon, everyone. We're very excited to bring back Tim Powell for another in a series of the webinars that we've had here at Pack Energy. Tim, are you out there, sir?
I am here.
Awesome. How are you doing this afternoon?
I'm good. I'm good. I'm really excited to do this. My team downloaded the annual reports and some other affiliated SEC filings for 22 public companies, all going back to inception for all of them. It's close to 45,000 pages of information. Um, it I've never really done a deep dive in my time in the mineral space around publics. These documents are extremely dense with ChatGPT now and AI. You're able to comb through this information. So I've been interacting with it for probably 3 weeks on a lot of questions and analysis and how about this? What about that? Let's cross compare these things. And it was a lot of fun. I learned a lot about structure and balance sheet management and how that really affects certain M&A activity, which is what I traditionally follow in the public space, is just what deals get announced. So it was really cool to look under the hood. I hope everyone listening learns something and enjoys it, but it's a new kind of topic for me, if you may, and a level of analysis I quite frankly with ADD could never do as a human. So I'm looking forward to diving in.
Well, awesome. Well, we're very excited to have you presenting with us again today. I do know that there may be a little bit of last minute things that were brought in. Very exciting. We'll see. We're just a little teaser there. So we're again very excited to have you here. And for those who have seen Tim before, you know that he provides a lot of great information. He has an amazing team that does all this research to assist him in these things. All of those webinars are available on our resource page. And then we'll also have his contact information here at the end, along with mine. So if you do want to reach out, I know Tim loves to talk about this industry. And so if you have questions and whatnot, feel free to reach out. That being said, for those that are new to the webinar, we do have the chat feature turned off. However, you can submit questions to the Q&A section. Just tap on the status bar. There should be an option for Q&A. Feel free to type in a question at any time. When we get through the webinar, if we do have time allowed, we will go over those questions. If we don't, I do know that Tim or somebody from his team or somebody from our team will reach out with those answers to those questions. That being said, before we get started, we always want to remind everybody Tim is an expert in the field. I'm here just moderating and facilitating as needed. But as conversations are brought up, sometimes opinions will be provided. We always recommend before you make any decisions, do your own due diligence. As I mentioned, Tim loves to talk to people out in the field, so feel free to reach out to him if you have additional questions. But we just make sure that you realize that these are a lot of data here, but also just make sure that before you make any decisions, you talk with your internal groups and also do your own due diligence as well.
Yeah,
That
and
being said,
an,
oh, go
an
ahead.
additional disclaimer from my end. One, this is all around public companies. I'm not promoting any company in particular in terms of investments or anything like that. So this is meant to be educational and get you more comfortable with kind of the frameworks and everything. And then the other is, the fact that I did spot check a lot of the information here, but I did rely on ChatGPT to comb through the 40,000 plus pages. And so a small disclaimer, if something is a little off, that may be a reason for it, but I'm almost confident all of it is accurate and up to date.
Almost confident. And like I said, Tim's also available if you have any questions. He's more than happy to answer those. I mean, who doesn't use ChatGPT or some kind of AI component to compile information?
Yeah, and
That
by the
is
way, it's not as simple as just uploading everything. I mean, you have to do it in batches and iterations, interact with it, and to get the end result here. So yeah, I wasn't being lazy. I didn't just say, ChatGPT, create me a presentation, but the ability to comb through all that information is really, really cool.
awesome. Awesome. Well, Thank you for that additional information. That's really important as well. So, Tim, that being said, you have the floor. It's all yours.
All right, let's jump in. So, just to set the table, I have categories here for the companies. These are the companies we're going to analyze today. I've categorized them as pure play mineral companies, pure play non-op companies. And if you go to the next slide, we also have what I'm calling hybrid land and surface, hybrid royalty with coal, hybrid, we'll call it the other category. Some have E&P, some have precious metals, some have infrastructure. And then we have the oil and gas royalty trust. Now, in combination, this is 22 companies. There are a lot of royalty trusts. I selected just the Permian Basin Royalty Trust and the Sabine Royalty Trust because they're the biggest and the most relevant. And 2 days ago, the Permian Basin Royalty Trust announced a $2.2 billion combination. So one of the reasons I selected them is stuff like that is possible with them and possibly Sabine in the future. So that's the universe of folks we're going to be looking at, and now we can dive in and get started. So, one of the things I thought about, like, where do we start, right? If we're going to start to analyze the public company universe, for me, I always want to start with transactions. I actually am going to end this presentation with transactions. And as I went through everything, I realized you have to understand the tax structure, the ownership structure, and the governance structure to actually reverse engineer a lot of what happens around balance sheet management and then ultimately what happens in transactional activity. So we're going to do a little bit of a primer there and then group the universe into the tax structures. And a disclaimer here, I have a slide talking about the Permian Basin Royalty Trust combination, but I literally saw it an hour ago and did a little write-up on LinkedIn and did not have time to update all the affiliated slides that their name would need to be poked into. But I will do that retroactively after this presentation when we send it out. But in the interim, we capture kind of the updates of that deal in one slide that we insert in. So let's jump in, Joel. So here's kind of the three tax entity structures. You have royalty trusts, MLPs, and public partnerships, and then C corps. And really, the evolution of what we've seen is the royalty trust is kind of the first gen royalty company, right? Then, MLPs were what was in vogue. I think MLPs were really hot. If you remember the EMP MLP didn't really end up so well. Midstreamers were MLPs in the 2000s. And so when Viper originally went public, and then you had Blackstone Minerals, which was 2015, they were all going as MLPs. Viper later converted into a C Corp. But when you look at a majority of the companies and a lot of the companies that have either changed their structure or have IPO'd later on, they're all going the C Corp route. And that is because it gives a lot more flexibility for a variety of reasons, which we'll get into in a bit. But that's kind of the universe that the companies fall into today. And let's go to the next slide. And so this is very basic. We don't have to really this is a visual. We're not going to go into excruciating detail here. The royalty trusts are basically set up to hold assets and distribute income. They're not really actively managed. They're not buying things. They're not taking debt out. They're just a public vehicle that has, public liquidity with investors, and they're just distributing cash, and they're meant to maximize cash flow distributions. Next slide. And so you have some of the advantages here. I think very low drag, right? There's high transparency on what the trust can and can't do. You're getting a pass through on commodity prices because there's such low drag. If you want exposure to royalties within this portfolio, this is a great way to do that. But the disadvantages are a trust become outdated very quickly. If there's technology innovations or new developments, you can't go and acquire assets. You can't dispose assets if there's a good opportunity to monetize them. You can't, use leverage or any of the things like that. So It's really kind of set in stone and just Joe, what was that oven years ago? The set it and forget it. Think of royalty trust as the set it and forget it in terms of structures.
Like the easy bake oven kind of thing.
Yeah, 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 exactly, exactly. All right, next slide. All right, so notable royalty trusts, TPL, which converted to a C corp in 2021, was it was a royalty trust for 130 years. It inherited it from the one of the railroads, one of the most coveted positions, in the country, all along the Permian in West Texas, on the middle and the Delaware side. Absolutely incredible. And because of the shale revolution and all the development of the water space, all the extra development, they repurposed TPL into a vehicle that could actively kind of take advantage and further monetize that position instead of it just maturing on its own. You have the Permian Basin Royalty Trust and Sabine, which are kind of the two big ones that are left. And then you have all these other kind of tiny guys that I mentioned on the right. And again, I think with Permian Basin Royalty Trust being the latest of these kind of structural changes or combined entities, I think we could start to see the royalty trust model come back into the headlines. And I think it's using those as you think about the royalty space. And when I talk to buddies of mine who are running private equity backed portfolios, which are traditionally the ones with the largest commitments and have traditionally built the largest portfolios in terms of NRAs, it's getting harder and harder to build scale. So when you're looking at going and taking a legacy asset that's already established, that's just sitting there and just being distributed, can you take that asset and combine it with ground game, with water, with data center, just a variety of other things to create a really interesting public vehicle or possibly a take private? I think the answer is yes. I think we're going to see more of that. So stay tuned on that space in the next 5 years for sure. Next slide. And so here's the deal I was referencing. SoftVest, which is a registered investment advisor out of Abilene, one of the largest investors in Permian Basin Royalty Trust. They just signed an agreement with Blackbeard, who's a major operator in the Central Basin platform. And they affiliates of theirs through NGP, Nile Midstream, who has a lot of water and midstream takeaway infrastructure, are all kind of contributing assets and combining in a transaction worth 2.24 billion. As one of the largest unit holders, Softwest has already thumbs up the deal, but you're just waiting for the formal vote for everything to go through. And I think that there's no expectation it won't go through, but 111,000 NRAs, 68,000 surface acres, all in the Central Basin platform, all contiguous around the historic Waddell Ranch. So really, really incredible asset there. They're set up to benefit from surface, easements and aggregates and data center development, new drilling, obviously, all sorts of different revenue streams, water. So think of it as kind of that TPL, Landbridge, Eagle Rock type structure, and what they continue to do going forward if they're going to grow it, bolt on, do additional things now is really, really interesting for sure. And the other footnote to mention here is that the Permian Basin Royalty Trust had a net profits interest that's been converted into a cost-free 15% royalty interest, roughly converting to about 31,000 NRAs. And the working interest aspect of that associated with the MPI is being contributed over to Blackbeard, and Blackbeard, in a sense, is going to trade back additional royalties. So some restructuring here that happened, but again, an exciting new player that we didn't really have on the roadmap, in the last few years. So really, really excited to see how that unfolds in the upcoming years. Next slide. All right, so moving on. So we did royalty trust. Now we're going to go to MLPs, and the whole the whole idea around MLPs is just the unit holders own assets directly into a vehicle. We'll show you here like kind of the nuances between um, the MLP and the C corps and everything, but this is the general flow and the tax implications. Next slide. And here are some of the advantages and disadvantages. So in the sake of time, everyone can kind of review these as we get in, but I want to go into kind of the company by company specific. So next slide here, Joel. And here are, the MLPs currently in the mineral space. So Dorchester has been public since 2003. Alliance is a coal company. Blackstone IPO'd in 2014 or 2015. And interestingly enough, they have not changed their structure. Um, Kimball has changed their structure, but in a unique way. So Kimball created an Up C like structure, which is typically a C corp structure, but it's within an MLP framework, referred to as an Up MLP. So quite unique there. Blackstone has really been more focused on maximizing distributions in a tax efficient way. And so they've kind of stayed with the traditional MLP framework. Kimball changed things up in the way they did to facilitate more acquisitions, which we'll get into in a little bit. But the MLP space, as I mentioned, not as vast, but this is the representation of the companies. Next slide. And then lastly is the C Corp. So the C Corp is going to have subsidiaries that operate and own the assets, and then you're going to have the vehicle where the public investors are, and it all kind of flows through and is tied in this way, as the flow chart says. Next slide. One of the major advantages as I dug through all this is just the optionality that a C corp sets up for the companies that have that structure. And the idea, you can do dividends, you can do buybacks, you can take on leverage. There's a lot of creative ways to do transactions. And so you'll see examples of that as we go through the presentation. But make no mistake, the most active M&A oriented publics have C corps, and there's a reason why they are. As you look at being a counterparty on the other side, I think in addition, in a world where not every deal is all cash, the kind of playbook or the tool belt that C corps have is quite vast, and enables more deal making for sure. Next slide. So this is a snapshot of the universe of C corps, and you can go ahead and add, if there's shareholder approval, permanent base and royalty trust will be one of these as well. So if you move on to the next slide here, we'll start diving into some of the details. We're going to look at C corp structures in the public non-op space, and there's only three publicly traded non-op companies, so maybe it's a function of there's just not a lot of companies, and if there was more, maybe you'd have a more diverse structure. But one of my questions when looking through this was, is is a C corp, well, one, they're all traditional C corps, number one. So two, is an Up C structure not a good fit for non-op companies? And the answer is not that it's a bad fit. It's just that the way these publicly traded non-ops have gone about their business, the upstream Up C structure hasn't really been necessary. And the other question is, why aren't any of these C corps, right? Does it have to do with the ongoing cost exposure associated with non-op? Does it have to do with the leverage? I think the main point is broader investment access in the capital markets. If you're set up as a C corp, it's easier for them to go out to institutional investors, right? Whereas you have a lot of mineral companies like a Blackstone or a Kimball, who originally were built off of asset contributions, right? From family offices, from ranches. And so some of the structural nuances there, were important when those folks started from a tax perspective. Whereas, a Fidelity isn't going to have the same tax concerns and structural concerns as a family office in Dallas, if that makes sense. Next slide. And so this is just kind of one of the other a follow-up to what I was just saying on why are our C corps being purposed into to non-op companies, and or taking a step back, why are most of the companies C corps? And I think the quickest way to look at it is C corps help facilitate growth strategies, right? And I think a lot of companies, when they go public to access cheaper cost of capital to then facilitate growth. When you look at the companies that are less growth oriented, it's the royalty trust. It's like a Blackstone Minerals, a Dorchester. Yes, Blackstone Minerals is acquiring assets with their ground game. They're doing things strategically. We'll get into kind of their development partnership playbook later on. So there's different ways to kind of accretively add value to shareholders in those entities. Same thing with Dorchester. They're doing acquisitions, but it's not Viper, it's not Kimball, folks going out doing multi-hundred million dollar, multi-billion dollar acquisitions on a regular basis. And so that's one of the reasons why you see the less aggressively growing companies in MLP or royalty trust structures. Next slide. So let's look. I wanted to just point out Lambridge. They're a public LLC, but they're taxed like a C corp. So again, some nuances here, and I'll let everyone kind of follow up after the presentation to kind of read through the details. But this is just when you go through all these 22 companies, you realize every single company has a little bit of a wrinkle in their tax structure, their governance structure, their ownership structure. And one of the key takeaways is there's not like a best way to do it, quote unquote. It really has a function to do of what the capital markets want at the time of the formation of the company, what the growth objective is, how the asset base came together, i.e., who are the stakeholders? Is it private equity, institutional? Is it one owner? Is it multiple entities? And so a lot of this stuff really kind of caters to all the players at the table when the IPO or the SPAC or whatever the combination happens, right? And you try to cater to everyone's needs and then to also the vision of the company going forward. Next slide. And then, this is something I was actually familiar with because I started my career in Canada, but it will be something a lot of folks in the US aren't really familiar with, and that's the Canadian Cross-Border Royalty Trust was very, very popular in the 2000s. Like many governments do, they like to stifle and break profitable things in the private market and take their fair share, which ultimately ends up shooting themselves in the foot because it actually lowers economic productivity. So good job, Canadian government, on killing a part of the oil and gas space that was thriving in the 2000s. But long story short, the Canadian Income Trust, may it rest in peace, had a good 15-year run. Freehold was originally under that structure. They changed to a C corp because of a legal change required by the Canadian government, and then kind of shifted into a more growth-oriented cross-border player, like we've seen in the last 5, 6 years with them doing acquisitions in the U.S. But there's just an evolution that is going to be different than the U.S. counterparties because it wasn't for tax efficiency or, trying to grow more. The change in structure was actually forced upon them by the government. Next slide. And then this is, we're not going to talk about Source Rock royalties too much today, all things considered, they're very, very small, but I think it's an interesting case study. This is something that I've talked about over the years. If you've, listened to me speak at conferences and everything, it just is a food for thought. And that's the concept of should there be a junior public royalty ecosystem, right? And so SourceRock IPOs in March of 2022 on the Toronto Stock Exchange Venture Exchange, the TSXV, and they IPO'd at what's the total number here? Like 30 million, like really tiny. And that's Canadian dollars, which, is probably depending on the FX 20, 25 million US. And they're only focused on Canadian gores, basically royalty financing for upstream development in Canada. And they've kind of slowly, steadily grown their asset base over the years. But, instead of like going into and saying, is Source Rock a success or can it get bigger or what have you? The idea is there is a juniorly traded royalty company right now in Canada, and there are so many assets in the US that I would argue have 100 to 500 million dollar market cap equivalent enterprise value that could go public in a junior market should the management teams want to do that. And if you go to the next slide, Joel, there's kind of a history in Canada of how a vibrant junior market in the E&P space. I would say from late 2000s to to mid 2000 teens, like call it a decade, the junior E&P market thrived. You have a company that had two guys and a dog and a cat could go and launch a public company with a couple $1 million in the bank, go and just bootstrap and build a company up to a couple thousand barrels a day, and they would exit. And so one of the constraints the junior market has faced when ESG came and a lot of banks started to shrink their lending in traditional hydrocarbons, what was just who they could lend to. And it ended up being mid and large caps in Canada. So the juniors were kind of left out of the party. And when you look at the royalty space, you don't really need leverage, right? If you do use leverage, it's typically pretty modestly on large transactions. And so that kind of removes that barrier of entry or that friction, if you may, for a royalty company to go and just access the retail market in Canada, which I would argue, the slipper on Cinderella fits a little bit better. It's a smaller market, probably a tenth the size of the US. And a lot of these companies that are publicly traded over the years in the US have struggled purely as a means of scale and trading liquidity, and institutions can't get in them because there's not enough float. And in Canada, that's not an issue. There's institutional investors in Source Rock. So I don't know. Something to think about. I think that the Toronto Stock Exchange makes the most sense, but it could be London AIM, it could be ASX. These are junior markets that have oil and gas educated investors already. And I think they're more used to funding exploration internationally on these exchanges. And so the the income and the yield, I think, would be so attractive to these investor bases that they would be willing to pay a lower discount in order to access that kind of secure income. And then the other thing to think about of like why the junior market would happen internationally and not domestically, I think there's some case studies of just you really need scale in the US. PHX Minerals was over the counter. It was kind of like 100 to 200 million market cap and just kind of bumped up and down around that range and just really had trouble poking its head through the ceiling. Falcon went public around 400 million market cap, give or take, I believe, and really, did some small accretive acquisitions along the way, but had trouble kind of breaking free of that range and ultimately merge with Brigham to get scale. And so I think the junior market in the US doesn't really seem to make sense given the track record of PHX and Falcon, but maybe the junior markets internationally could be an incubator. And you see the capital markets ladder at the bottom. Maybe that's a playbook, right? Maybe you start private. If you're listening here, $50 million royalty fund, three iterations over. Now you got a nice little AUM. You go public on the TSXV. You grow that and graduate to the regular TSX, and then maybe you cross list into NASDAQ once you're in the billions of market cap. So just one thing to think about. I would say one of the barriers is that I don't know a lot of people in the mineral space that even want to run a public company, right? Kudos to Daniel Hers and his team at Whitehawk for getting their IPO across the line a couple months ago. But Daniel and his team have run public companies their whole career. A lot of guys and gals in the mineral space like being private. They like running four-person teams. So, that is inherently a challenge. But nonetheless, all that aside, I think there will be a chapter of the junior public in the royalty space in the future. Mark my words. I don't know when it'll be, but I think it's coming. Next, Joel. All right, let's jump into ownership structures. So, next slide. This now, I kind of looked at it as like the second layer. So, you kind of have the tax structuring, and then you have the ownership structure. So, the ownership structure basically tells you how the publicly traded security is connected to the underlying assets. Um, the the up C and up MLP, the main takeaway I want everyone to kind of come away from on this is the up C and the up MLP structures are really engineered for the folks who want to be the most active in the M&A space. And you look at Viper, you look at Kimball, Whitehawk is just getting going, but if you look at Daniel Herz's rhetoric over the years, he wants to be consolidated. He wants Whitehawk to get big. And so that kind of structure enables you to have, as I mentioned earlier, a lot of optionality on how you can do deal making. And we'll dive into kind of how all these things work. So next slide. All right. So the up C structure, the simplest way to think about this is when you do a transaction as an up C, you go to the buyer and you say, okay, do you want to get cash? Do you want to get our stock? Do you want to get units in our OpCo, which is the operating company that holds the assets, and then you have the option to convert those OpCo units into public shares later on. So I just had Darren Zanovich from Mesa Minerals on my podcast about a week ago. They just did a transaction with Kimball. Kimball's an Up C. He described the Up C structures almost like a 1031 exchange, which is a really interesting way to look at it. In that you can get, if you decide to go into the public stock, there is tax implications there. If you sell for cash, there's tax implications, but they did a portion of everything, and they have a bunch of OpCo units, and so they're able to basically continue getting yield through the distributions from Kimball stock. They were able to get further diversification into the OpCo of Kimball, but they're not converting those shares into public shares yet, and so there's no tax event. So it's a great tax deferral mechanism. And so when you're looking at your optionality as a seller, it makes a whole lot of sense for whatever something sells. It really is what am I getting after Uncle Sam takes a bite out of it? And so tax strategy matters a lot, and that's why I've started this whole presentation around structure because it really matters. And there's a reason why Kimball is doing so many transactions because I think there's a lot of counterparties they've done deals with who find this kind of optionality really, really compelling. Next slide. And these are advantages and disadvantages. In the sake of time, I'll let people look through those on their own time, but let's jump into the next structure. All right. So the Up-C structure right now as it stands, and by the way, Permian Basin Royalty Trust is going to be an Up-C as well. These are the three companies. Again, Whitehawk is new, so it'll be interesting to see their M&A behavior going forward. My prediction is they're going to be very active. Lambridge is the land management version, right? And so they could be the Kimball or the Vipo, the land management space potentially. Although Permian Basin Royalty Trust now is in their space, and so I think both of those will be very active. Viper converted from an MLP to a C corp with an Up C. And after doing that, you see a significant uptick in their M&A. They've been consolidating billion-dollar transactions pretty regularly. And so that when you look back at the history books of Viper's deals, there's a big reason. It's kind of like before C Corp Up C and after C Corp Up C in their M&A history. Next slide. Yeah, and then this is I apologize for referencing Kimball on the Up C structure before, but in principle it's the same. They have an MLP, but they have an Up MLP structure, so the same type of dynamic with an operating co holding the assets, and you can get OpCo units. It's just partnership units, right? Instead of LLC units. And it's very tax efficient and it begets M&A activity. So I think this is a function of Kimball seeing the benefits of an Up-C structure, but they were already an MLP and wanted and also are very income and distribution focused with their investor base. And so I think all things considered, the MLP plus this structure has made a whole lot of sense for them. Next slide. All right, governance. So this is another layer to look at. Next slide. All right, so the categories I've come up with are independent, right? So it's just independent management team, their board, founder controlled, so they're public, but it's kind of like they're privately controlled, but in a public shell. A sponsor relationship, i.e., the line of sight partnerships, Topaz with Tourmaline, Viper with Diamondback, Lambridge with Waterbridge. Externally managed is kind of interesting. In a lot of respects, I would say KKR has a heavy hand of influence on Crescent Energy, Granite Ridge with Grey Rock, and then Freehold until recently had an external management arrangement, master services agreement, if you may, with Rife Management. And then there's the trustee administration administered model, which is set it and forget it, as we joked about before. Next slide. So key punchline here. If you have a parent relationship, there's a competitive advantage, right? I think there's a competitive advantage on uh, underwriting for line of sight. There's a competitive advantage on balance sheet strength and getting more institutional grade capital markets access through the parent. And then, the ability to do drop downs, right? And get scaled M&A over time, and then have a combined kind of 1-2 punch on M&A upstream. So Dimeback and Viper can go kind of collectively acquire big E&P assets that have lots of minerals and royalties in them, and then Dimeback can drop them down. Uh, Tourmaline and Topaz, Tourmaline is largest gas producer in Canada. Anything with infrastructure and with royalty assets, Tourmaline can acquire and then drop down similarly. And then Waterbridge Landbridge is kind of that water surface management example or version of what I just described with Viper and Topaz. Next slide. This one's interesting. I actually had to kind of understand exactly how this works. So thank you, ChatGPT, and being patient with me on that, because my understanding was that a lot of these assets that were owned by KKR were still held privately, and KKR still has a pretty significant royalty portfolio held privately, but there was a bunch of assets that were in, included in the portco of Crescent Energy when they went public a few years back. And now they have this separate entity internally called Crescent Royalty Finance, and it's its own kind of subsidiary. It's not its own ticker, but it is within the public umbrella. And I think it's a different structure than what we've seen. My understanding is that it not only it basically creates optionality for Crescent Energy, right? I think if Crescent Energy wants to go, remember they're an Up C, right? So if they want to go and acquire, an E&P portfolio that has a lot of uh, royalty assets, doing some sort of drop down or keeping it in the Crescent Royalty Finance OpCo is an option. My understanding is they can use the cash flow from the royalties assets and leverage them differently, get a different debt facility in place, then go and actually finance operating activity with other operators, as well as Crescent Energy. So really encourage everyone to kind of look at this slide offline and dig into the presentations and kind of fully understand it and the implications in the broader market of how they might compete in the Eagle Ford and how they could be a good buying counterparty. But really, really interesting. And they did a $350 million two deals totaling $350 million of royalty assets in the Eagle Ford earlier this year. So clearly a significant player and likely to be, a significant player at a minimum in the Eagle Ford for minerals and royalties portfolios going forward. Next slide. So this is I'm gonna just knock out these slides very quickly. There's three coal companies that are currently actively acquiring minerals and royalties. I just wanted to show the flow chart. Again, this section is around governance. So it's just to show you that there could be a lot of companies out there that have businesses that diversifying into minerals and royalties makes sense, and they would just create subsidiaries that are controlled, and then you get access to the corporate balance sheet, the corporate liquidity. And so, NACCO Industries, which is a coal company, North American Coal, they have a subsidiary called Catapult Mineral Partners, which I'm sure many on this call are familiar with, out of Frisco. But this is just kind of the general flow of how it works. And if you go to the next slide, you'll see the breakdown of Pardee, which is probably the tiniest of the companies, less active, but big legacy position in Appalachia, some stuff in the DJ, some stuff on the Gulf Coast, but they're really a diversified natural resources company and royalty company, right? And so it's almost like a version of these royalty trusts being repurposed to do things creatively in the Permian, like we saw with Permian Basin Royalty Trust. I think that's almost like an internal like restructuring you're seeing with Pardee and with NACCO Industries through Catapult. And then next slide. And then finally you have Alliance, and Alliance is by far the biggest and most active player in the mineral space from the coal universe, and they continue to put call it 100 to $200 million to work a year on new acquisitions. They have a standalone team, as does Catapult. Is just Alliance is now, which is run by Kirk Tolan, really operating as its own entity and is spitting out anywhere you see here in 2025 137.8 million in royalty cash, and they look to reinvest all that or around that every year. They just did a 200 $6 million acquisition recently, and so Alliance has become a really active player. I think the food for thought that happened a decade or so ago when they got into the space was, okay, what other coal companies are out there, or what other companies that kind of look and feel like the coal business, which are parallel to the oil and gas mineral space, where diversification into minerals and royalties makes a whole lot of sense for their company. We'll see. I think we'll continually be surprised, but there's asset bases out there that can be combined with oil and gas royalties to make them very compelling stories for publicly traded public investors. Next slide. All right. So, which structures have changed over time? And I've kind of mentioned some of these. And I kind of talked about this, like the errors, if you may, of the structures. Royalty trusts were wave one, MLPs were wave two, and now we're definitely in the C Corp era for sure. Next slide. And, because the C Corp is more in vogue, it gives more optionality, as I've mentioned. These are five companies that have changed from a legacy structure into a C Corp. TPL went from trust to C Corp. Viper went MLP to C Corp. Freehold, as I mentioned, was a Canadian royalty trust into a C corp. MLP or Kimball is the MLP up MLP, so kind of a nuanced restructuring within the MLP framework, and then Crescent Energy went from just a traditional C corp to, or actually eliminated the up C framework. Next slide. All right, so that's the structure. Hopefully that sets the table and everyone can kind of understand where to fit everyone into different buckets. Now we're going to talk about strategies being implemented in the market that are unique. I like to look at the publics as who has a niche doing a certain type of transaction with a certain type of buyer, and even potentially in a certain area, right? So I think Dorchester is arguably the most tax efficient acquisition structure. So for someone who owns mineral assets and they want to continue to own mineral assets forever, but maybe their asset is in decline, maybe it's very, very concentrated on gas versus oil. Maybe they're doing estate planning and they want to, simplify things for their heirs and they want them to have the mineral ownership, but units in Dorchester stock's a lot simpler than a private, estate that's going to get cut up between 12 grandchildren. So for the forever holder, individual or family that wants to contribute assets into Dorchester and get units in exchange, extremely tax efficient, incredibly attractive, good, strong yield on a monthly basis. That's kind of, I think, that type of seller is going to gravitate towards Dorchester. And one of Dorchester's largest deals they've ever done was with Carrollton and some of their legacy funds years ago. And it was a pretty concentrated Permian position. It raised a lot of eyebrows on, you know, Dorchester doesn't really typically do deals like that. They're typically more diversified. So what are they doing a deal like that? Not, my interpretation is that is Carrollton has a lot of oil money, families in Dallas, et cetera, that probably wanted the long-term ownership and wanted a monetization out of the fund structure, but didn't really necessarily want the taxable event that comes along with that. And I think that's ultimately why they were able to marry and do a deal. Kimball, we've mentioned already. I think they are extremely tax efficient as well and can offer a lot of different things public equity, OpCo units, cash. They can do deals with all sorts of types of counterparties, corporates, families, et cetera. So I think, in terms of tax efficient solutions in a public exit, Kimball and Dorchester are the two main ones. And it's just kind of now understanding who the seller is and what their specific objectives are on whether or not, Kimball or Dorchester are a fit. And I would argue kind of the larger, more corporate deals are going to cater to Kimball. Franco is interesting. I think Franco, they have a 20% rule, meaning they aim to have no more than 20% of their revenue coming from oil and gas royalties. The rest comes from precious metals. I think, for the most part, precious metals and oil and gas aren't really correlated. And so they might be at an advantage when oil and gas prices are going down. And a lot of their counterparties, like a Kimball or a Viper, might have a little bit of depressed equity power in the markets, if you may, because of depressed commodity markets. Franco might be booming with their precious metals business and have more cash and be able to come in and be a counter cyclical acquisition player. An example of this is them buying some assets during COVID from Darren Zanovich at Mesa in the Haynesville. So just more of kind of my own insight on that, but they also have an incredibly low cost of capital, close to a $40 billion market cap company, if I'm not mistaken, and just investment grade globally. So access to that level of investor enables them to, have a cheaper cost of capital that they're able to pull levers down on. Next slide. I already mentioned, some of the advantages of Viper. I think that relationship with Diamondback is really key. large E&P portfolios with large minerals assets, I think Viper Diamondback become really, really interesting. Whitehawk is the first and only publicly traded company focused exclusively on natural gas minerals. So anything that's natural gas oriented in Appalachia, Haynesville, I think they become the logical buyer. And I think that's a niche they can really lean in on because their investors are kind of buying into the tailwinds of data center development, natural gas, et cetera. TPL, I think if you have a large minerals position and surface in the Texas Permian, that ultimately could be a very interesting, compelling argument for TPL to be the logical buyer, especially if they have such a big position. If their legacy acreage or surface or minerals on their, if you look at their map, the checkerboard, if an asset overlays with that checkerboard a lot, TPL is going to be very, very competitive. If you look at their last few large transactions, anything that overlays their existing portfolio, they're typically taking down. And then Blackstone is interesting. They haven't really done acquisitions. They're leveraging their legacy portfolio in a different way. They are negotiating development partnerships with E&P companies and non-op companies by giving preferred royalty rates, preferred lease terms in order to incentivize and guarantee development in certain areas. So we'll get into that at the end of the presentation. But again, a very, very niche thing that's different than a lot of the other publics. Next slide. For NOG, I think NOG is, they're the preferred co-bid partner with E&Ps. They kind of built the playbook around that. They also are the biggest non-op company. That scale is going to enable them to take on more concentration. They might be able to take on a deal that is heavily concentrated in certain units, heavily concentrated with certain operators, and they can absorb that because they're so big. That matters in the non-op space if certain deals come to market and it just doesn't tick the right boxes for a smaller fund because of concentration, limits, right? Prairie Sky is interesting. They went public before Viper. A lot of people think of Viper as starting the public space, but it was Prairie Sky was the first one in 2014. They've stayed exclusively focused on Canada, and I really think they're almost like a version of what Blackstone's doing. They do a lot of geologic work. They're really trying to promote their own 19 million acres of lands and get exposure. And so they have over 300 operators, a lot of data, and they're constantly using that to go and promote additional development on their lands. And then I already mentioned Crescent. I think the royalty financing platform is really interesting and unique. And time will only tell what they're going to continue to do as a buyer. But the $350 million acquisition in the Eagleford early this year, I think is a precursor to some more activity to come. Next slide. This is just a quick overview of who's doing minerals and non-op in Canada. I won't go into the details. All the companies in the first four companies are all publicly traded in Canada. Topaz does midstream infrastructure and royalty finance. NOG is the only publicly traded company doing non-op, and that is a space that'll grow. On the private side, you have Fortuna and North Hudson did two deals with operators over the last 2 years. NOG just announced a $260 million JV with Parallax, which is a Carnelian Portco in the Duvernay. And, the whole upstream space is for the taking in Canada. I think there's going to be more and more partnerships, and as more and more non-op capital is raised, Canada is a jurisdiction very similar to the U.S. in terms of pro oil and gas and developed and infrastructure and all that. And so I think watch the non-op space in Canada, not minerals and royalties. There's not a lot of growth there, but watch the non-op space. Some interesting stuff to come. Next slide. So this is kind of the emerging land surface royalty infrastructure universe. We had an IPO with Eagle Rock earlier this year. Assets were contributed by Double Eagle and NCAP. We had the combination I've mentioned several times with Blackbeard and Permian Basin Royalty Trust. You have TPL, you have Landbridge, and water bridge. Water, data center development, minerals, uh, renewables, carbon sequestration, just monetizing the entire bundle of sticks of value in land and mineral ownership and the entire aspect of the development ecosystem in oil and gas. That's what these companies are built to do, and this is not going to stop. They're going to be more. I think you're going to see it in different basins. A really, really exciting new hybrid model, and I think the sky's the limit. It'll be interesting to see, whether these companies diversify into other basins or they diversify or you have new public entities in other basins form. Next slide. All right, share buyback programs. And by the way, I apologize, everyone. If you need to jump, I know I'm coming up at the end of the hour, but still want to spend a little bit of time running through everything here and wrapping up the presentation. So when I look at buybacks, this is a quick summary of who's the most active to who isn't, right? And so you can kind of see the little star rating there. Top guys are TPL and Viper, Prairie Sky, Crescent, right? If you go to the next slide, you have the less active, right? And I think every single company has more individual reasons why they're not doing buybacks or not. I think one of the major things is buybacks is an option on the tool belt to create shareholder value, and so you need to be a C corp really to be structured to do that most effectively, I think. And if you're more income oriented or distribution oriented, you're less likely to do buybacks versus more of a growth oriented company. So you see Kimball, Dorchester, these folks, and then the royalty trust, right? These folks are focused on distributing, maximizing distributable income to investors. And so that's just one of the signals. But I have them summarized. If you want to go to the next slide on, why companies are having more active buyback programs versus others. Um, So I think the common takeaway out of all this is if you have a more active buyback program, you have strong free cash flow, you have a flexible balance sheet, and you have a management team that treats buybacks as a competing cost of capital versus M&A versus distributing to shareholders, et cetera. It's the main takeaway. Next slide. And this is kind of your mid-level, folks that are doing it sometimes but not consistently. You start to see um, in these types of companies, acquisitions, distributions, organic development being more of a priority versus buybacks. And they tend to do buybacks only when it trumps all those things and it's not a primary program of the company. Next slide. And then the folks that really aren't doing buybacks at all. They're again focused on capital preservation, distributions, et cetera. And then, the others that I would argue may do buybacks in the future, but it's just too early to tell. Whitehawk, Eagle Rock, Lambridge are all pretty young companies. So the next 5 to 10 years, they may change their behavior in this category. Next slide. All right, now we're going to talk about leverage. So again, leverage and acquisitions kind of goes hand in hand. So surprise, surprise, the companies who are doing the most M&A typically have more leverage being used in their balance sheet. NOG being the top acquirer in the non-op space, Viper top acquirer in the mineral, and Kimball top acquirers in the mineral space. So no surprise there. Lambridge, having more infrastructure in their balance sheet can use more leverage appropriately because of the kind of the risk nature of infrastructure. So just a quick snapshot there, and we'll just go through the next few slides, Joel. These are some of the less active companies, and we'll go to the kind of the takeaways on the next slide. these are all the different reasons why these companies are using more leverage. I think the general takeaway is if if you have long live cash flowing assets, right, an established asset base, you're able to really maximize the leverage you can take out with banks as a facility to then further bolster acquisitions, right? And then through cash flow over time, you can deleverage yourself. That's the main takeaway across all these companies, all doing things in their different structures and different strategies. Next slide. And these are, companies where it's just they're using debt selectively. I think it's tactical, the right deal, the right opportunity, the right macro environment in the markets. They will selectively, draw down facilities, but it's not a central part of their business model, kind of like Viper and NOG as an example. Next slide. And then these companies, like typically, will kind of come out and say, we don't use debt, and that's a reason you should invest in our company. So it actually uses a competitive advantage, and just aren't really focused on needing debt to be leveraged for acquisitions because they're more distribution focused, as well as structural constraints, right? Like a royalty trust. Next slide. All right. So final section of the presentation. We'll jump in here. We're going to talk about M&A, right? And so this is kind of we set the table with structure, with balance sheet management to understand why folks are doing things in a transactional nature. And now we're going to kind of break down those transactions. So the two winners of non-op and minerals acquisition are Viper and NOG. NOG is consistently rolling up portfolios over 100 million. They are the OGs of the EMP co-bid non-op structure, and they're the player of choice in the EMP co-bid, process, if you may, when assets come to market. They have the ability to write $400 or $500 million checks, which others don't really have the ability to do. And they continue to grow and diversify over time. So, I have here some of the representative transactions. They're doing co-bids, they're doing development partnerships, and they're doing acquisitions of non-op portfolios. And some of the bigger ones, the XCL deal in the Uinta, the Novo Ursaring deal in the Permian, the Ascent deal with Infinity in the Utica last year, and then on just pure acquisitions, their largest one to date was Veritas about 4 years ago in the Permian. Viper's done, just over 13 billion in acquisitions, combination of mergers, drop downs, A&D, really, really dynamic. They're the only one in this category for minerals, right? They have done now $4 billion plus deals, in which the Endeavor drop down was almost 4.5 billion, and the Sitio merger was 4 billion. So really in a league of their own. And then other notable transactions, they have three above, 500 million. So they've done a lot. They've really kind of separated themselves from the pack in the pure play mineral space and will continue to be the consolidator of choice of kind of mega uh, portfolios, whether they're Permian or multi-basin, because they've proven that they'll take down a multi-basin portfolio if it has a scale, and then clean up the portfolio afterwards and divest out the non-Permian assets. Next slide. And then Kimball's kind of the Clyde Drexler to Michael Jordan of for Viper. Incredibly active M&A company. They're just doing deals all the time. They've done 20 plus deals. And I think their up MLP structure gives them a lot of flexibility, which I've mentioned on deal making. And these are some of the examples of deals they've done. Typically, kind of 100 to 300 million. Some marquee deals for them was Haymaker, close to 450 million in July 2018, and then Long Point 2 for 455 million in 2023. So they just did another, call it $380 million worth of deals in the last 2 months. And so Kimball just remains to be active. And, I think their structure has a lot to do with it and how attractive it is for counterparties who are selling. Next slide. Then there's another group of what I'll call opportunistic buyers. They're not doing a deal every quarter. They're not even doing large deals every year, but when they do deals, they're significant and they always have to be on the dance ballot when you're running a process. Alliance, is typically doing deals outside of their ground game, kind of in the 80 to $200 million range, most notably a $206 million deal in July of this year. Franco has done, kind of 100 to $300 million deals pretty repeatedly, like every 1 to 3 years. And again, I mentioned this earlier, their 20% rule is, when gas prices ran up super high from the Ukraine war, they actually got overweight on this 20% rule. Now that gold has skyrocketed, they're underweight. They're currently 11% of total revenue in 2025. My prediction is you're going to see Franco make a big splash at some point in the next 12 months to 18 months. Where that is could be Haynesville. They've done two with Mesa over the last 6 years. Could be somewhere else. They also own in Appalachia and they own in the Permian, as well as the Mid-Con. Next slide. TPL is really ramping up. They've done in the 2024 and 2025, 120, a 275, and a $450 million deal. I imagined they'll continue to just be there for the right chunky assets that are a strategic fit. And as I mentioned earlier, are overlapping a lot of their existing surface and minerals. Crescent, someone to watch going forward, specifically in the Eagle Ford. I already mentioned multiple times that $350 million deal. And then Freehold has become a very active player in the U.S. entering in 2021. They kind of have gone, it's almost like imagine big waves in the ocean. They're constantly doing deals. The peak of the wave has traditionally been around 150 to 200 million. The trough is kind of your $50 million size deals and your bolt-ons and your ground game. So Freehold has not done a deal since December 2024. My guess would be look out for Freehold to do 100 to $200 million of transactions in the next 12 to 18 months. Next slide. And then this is just another um, slide talking to Whitehawk. I think they're going to continue to roll up nat gas portfolios. This is what they've done as a private. Watch them going forward, specifically in Appalachia. There's a lot of portfolios up there that are 10 plus years old that I think are going to start to hit the market and monetize now that you have a player like Whitehawk in the market. Next slide. These are just a rundown of the surface and infrastructure and water and data center related transactions for the land management companies. On the sake of time, I'll let everyone look at those later on. Just wanted to cover that as like a different carve out subsector of transactional activity. Next slide. And then, one kind of interesting food for thought is, publics, they go public, their goal is to grow, they never sell, right? And the answer is kind of. Most don't, but I think companies have shown they're willing to be opportunistic with pruning where it makes sense. A lot of it is small and selective carve-outs. The two notable players that are doing large, they're not afraid to do larger sales has been Viper. Viper's sold $730 million worth of assets over the last 4 years. Again, kind of cleaning up the non-Permian stuff after large M&A. Blackstone sold $100 million worth of assets in 2020 to Pegasus. And TPL, separate from minerals, has done a lot of trading around surface and water and land. And I think that's a function of, a different business with a different type of objective versus holding minerals more longer term. Next slide. And then the last two slides here, thank you everyone for your patience, especially you, Joel, is talking about Blackstone's development partnership. So I alluded to this in the beginning of the presentation. They're not going out and saying, let's go roll up $1 billion portfolios like Viper. they're looking and they're saying, okay, we have this huge legacy position of minerals all over the Haynesville, traditional Haynesville, Western Haynesville, Haynesville extension, which is kind of in between. We're going to do geologic work. We're going to go and create partnerships with operators. We're going to give them better royalty rates. We're going to incentivize them to drill our stuff quicker. We're going to lock them in and have them commit to a certain amount of wells in a certain time frame. And this is just, an evolution. I'll let everyone look at the details on their own time, but Canaan Resources, Pivotal slash Tailwater, Aethon. If you go to the next slide, Joel, um, they've done stuff with XTO. They've done stuff with Azul. They've done stuff in the Austin Chalk. They've done stuff with Revenant and Cataris most recently over the last year. So really, really interesting to see them executing a different playbook. And most importantly, as they've ramped up these partnerships, you look at Blackstone not really quote unquote being active in M&A. They've deployed $250 million in ground game, bolting on mineral ownership in these areas to further bolster their ability to do these partnerships with operators. So, with all that being said, that is it, I believe, unless I have another slide, Joel.
No, no,
Forgot
that's
about.
it. Yeah.
That's it. I appreciate everyone's time. There's a lot of information. I had a lot of fun going through this. I've never done a deep dive on the public space in this way. I hope everyone, will send you this information afterwards so you can look through it. Devil's in the details, but some really interesting insights on how the public system really functions. So I appreciate everyone's time and attention. Thank you, Joel and the Pack Energy, for having me on again. And until next time.
Yeah, it's always insightful. So thank you so much, Tim. A lot of information, really good information, and I love how you just put it all together for everybody. Unfortunately, we are over time, so we won't have time for our Q&A session today. But there was a question in there. I'm sure that our marketing team or Tim can reach out and answer that question for you. Also, thank you to Pack Energy. If you're unfamiliar with Pack, we'd love to have a conversation with you. My information will be on the last slide. But we'd love to talk to you about how we can solve some of your issues or problems with the solutions that we have. Also, help you do some of the tracking of acquisitions and whatnot. We have great reporting solutions to help with acquisitions and when you're selling off assets as well. So that being said, Tim, again, thank you so much. Thank you everybody for who attended, and make sure you follow us on LinkedIn, reach out to us, and we have other webinars coming up very soon that we're very excited about. So you'll have a great day.